Hi to all. In this overview of CFA Level I you will watch the glossary lesson. Part B, Terms from M to Z. You will listen only the key terms like in the previous video, the Part A. Please, keep in mind that what we show is the CFA Glossary by the official CFA Level I Study Guide. Stay tuned and soon we will show you the new official study guides for CFA 1 and 2, gifts with total value of $500. The CFA Level I Glossary contains a wide range of financial, economic, and investment-related terms critical for understanding the CFA curriculum. Below is a well-detailed overview of terms starting from M to the end of the glossary, focusing on their significance within the Level I curriculum. These terms are vital for passing the exam and understanding core concepts of finance. M terms. Macroeconomics. The branch of economics studying the economy as a whole, focusing on aggregate measures like GDP, inflation, employment, and monetary policy. Key topics include aggregate demand and supply, fiscal and monetary policies impacts, economic growth and business cycles, market efficiency. Refers to how well market prices reflect all available information. 3 forms. Weak form, prices reflect past market data. Semi-strong form, prices reflect all publicly available information. Strong form, prices reflect all information, public and private. Important for valuation and portfolio management. Market risk. The risk of losses due to movements in market prices. Often measured using metrics such as beta, systematic risk, and value at risk, VAR. Mark-to-market. The process of valuing an asset or liability based on its current market price. Common in derivatives and risk management to ensure accurate financial reporting. Monte Carlo simulation. A statistical technique used to model the probability of different outcomes in uncertain scenarios. Widely used in options pricing and portfolio risk management. Mortgage-backed securities, MBS fixed income investments backed by a pool of mortgages. Key features. Pass-through security structure. Prepayment risk, extension risk, and contraction risk. N terms. Net present value, NPV, the sum of the present value of cash inflows and outflows, discounted at the required rate of return. A core concept in capital budgeting and investment decision-making. Positive NPV, the investment is expected to add value. Negative NPV, the investment is expected to destroy value. Nominal rate of return. The rate of return before adjusting for inflation. Important in distinguishing from the real rate of return. Normal distribution. A bell-shaped probability distribution commonly used in finance to model asset returns. Key properties. Symmetric around the mean. Defined by 2 parameters, mean and standard deviation. 68%, 95%, and 99.7% of values lie within 1, 2, and 3 standard deviations, respectively. Negative screening, an approach to ethical investing where certain sectors or companies, e.g., tobacco, weapons, are excluded based on specific criteria. O terms. Opportunity cost, the cost of foregone alternatives when making a decision. Fundamental in economics and capital allocation decisions. Option pricing models, methods to value options, such as Black-Scholes-Merton model, assumes a continuous market and no arbitrage. Binomial model, a discrete time approach to pricing options. Operational risk, the risk of loss due to inadequate or failed internal processes, systems, or external events. Managed through robust risk management practices. P terms. Price to earnings, PE, ratio of valuation metric calculated as PE equals market price per share, earnings per share. Indicates how much investors are willing to pay for $1 of earnings. High PE may suggest growth expectations, while low PE may signal undervaluation. Portfolio diversification. A risk management strategy involving the investment in different assets to reduce unsystematic risk. The foundation of modern portfolio theory, MPT. Put option. A derivative that gives the holder the right, but not the obligation, to sell an asset at a predetermined price before or at the expiration date. Present value, PV, the current value of future cash flows discounted at the appropriate rate. Formula. JavaScript. PV equals CF, 1 plus Rn. Where CF equals future cash flow. R equals discount rate. N equals number of periods. Q terms. Quick ratio. A measure of a company's liquidity, calculated as JavaScript. Quick ratio equals current assets, inventory, current liabilities. Indicates a firm's ability to meet short-term obligations without relying on inventory. Our terms. Risk-adjusted return. Measures investment performance adjusted for risk taken. Examples. Sharpe ratio, return per unit of total risk. Trainer ratio, return per unit of systematic risk. Real rate of return. The rate of return adjusted for inflation. Formula. Real return equals 1 plus nominal return. 1 plus inflation rate, 1. Regression analysis. A statistical method for estimating relationships between variables. Used in economics, finance, and portfolio management, e.g., kappa beta estimation. S terms. Standard deviation. A measure of dispersion around the mean, representing investment risk, volatility. Higher standard deviation implies greater uncertainty in returns. Systematic risk. Risk inherent to the entire market, also known as market risk. Cannot be eliminated through diversification. Securitization. The process of pooling financial assets, e.g., mortgages, and issuing securities backed by these assets. Benefits include liquidity creation and risk transfer. T terms. Time value of money, TVM, the principle that money available today is worth more than the same amount in the future due to its earning potential. Core formulas include present value, future value, and annuities. Treasury securities. Debt instruments issued by the U.S. government, including Treasury bills, short-term. Treasury notes, medium-term. Treasury bonds, long-term. Z terms. Zero coupon bond. A bond that does not make periodic interest payments and is issued at a discount to its face value. Its return comes entirely from the price appreciation as it matures. Conclusion. The CFA Level I Glossary, particularly from M to the End, covers a broad spectrum of topics essential for understanding the fundamentals of finance and investment. Mastering these terms will not only prepare you for the exam but also provide a solid foundation for advanced financial concepts in levels 2 and 3. Focus on the definitions, practical applications, and interconnections between these terms to maximize your understanding and performance.